Hello and namaste. This is Neeraj here once again, and welcome back to my channel Financial Market Analysis Twist by Neeraj Shah. So in today's video, I would like to discuss something regarding the margin compression which will happen going forward in the corporate earnings. So before starting this video, I would like to give a disclaimer that whatever the ideas and the stocks and regarding markets and all the ideas which are discussed here are my opinions and views only, and all the viewers are requested to do their own due diligence and research regarding the buying and selling decision, as I am no way responsible for their decisions. And if you like this video, if you please put a like watch till the end and share it with the maximum friends so that everybody can benefit. And if you have not yet subscribed to my channel, you please subscribe and push a notification button so that you can keep getting the videos as and when I come out with the new ideas. And also, if anybody wants a personalized consultancy regarding the stocks and the investment, you can contact me by email. My email details are in the description box down below, and then we can conduct these things. I will, regarding the charges and everything, and also regarding the premium video series, they can ask me. So before wasting much time, let's start. So in if you remember, I had come out with, and there are many this remarks before this budget last week, last week, that whatever it is, that budget just a formality, but going forward, the corporate earnings and multiples and the interest rate inflation scenario only will decide the stock market, and how much I am proven right, because only on the budget and the next day the market was very euphoric. Big vision, big vision. Vision doesn't take you. Vision is good for the long term future, but for the to give, suppose if a 20-year vision, but to reach to the 20-year, you have to survive you have to prosper also for 20 years. So if there are chances of, with all the situation, if you can't survive next 2 years, then you are not going to reach that 20 years vision also. So you have to maintain a balance between the near term and the long term vision. So in the near term, as we keep on telling, is that there will be a huge pressure in generally in the stock markets, because the inflation is very high. It is unbearable for the normal anybody, whether it is corporate inflation or whether it is the food inflation, whether it is the consumer inflation, because at the end of the day, if the inflation remains high, then the people will stop or will reduce their purchasing power, and because of that, disposable income also reduces, because the value of the money goes down either this way or this way. So it's about, if you don't tackle inflation through the interest rate hikes, then indirectly, rupee will come down, rupee will continue to fall and weaken further, and that will also increase the imported inflation, because India is a major importer of the energy, oil and gas. We don't have enough of, and that is the main basis of any cost increase. So today I want to discuss, and I want to show you that how this going forward for FY23 and also for the March quarter, this particular the March ending quarter in FY22 last quarter, and also FY23, that how the margin compression is going to take place, severe margin compression in almost all the sectors, all the industries, and because of this. So which are the major input cost for any manufacturing or any industry or any corporates? So major input cost is, say, for automobile, construction, or the metal sector, it is the power and the raw material. For automotive, it is the metals and the semiconductors and the rubber and tire. So it is again the commodity. For FMCG also is commodity, like food commodity like wheat, rice, oil. Biggest is the oil, edible oil. So these are the major input costs. And for any other consumer industries, it is also the chemicals, basically, whether it is organic or inorganic, but all kinds of chemicals. So these are the major input cost. And another, for the IT or for the technology sector, is the major cost is manpower cost, because they don't have any of these things. Mainly is the manpower. So more than 50-60% is the manpower cost. And in that also, with this kind of inflation and with this kind of, whatever the disruption is there, you are not going to get, your manpower cost is going to increase only, because if you want to retain good experts, good people, then you have to at least in rise with the inflation, you have to increase their salaries also. So that cost to the company is going to increase indirectly. So, and also the employee cost for all the other sectors also, manufacturing and other industries also is going to increase. So overall, there is going to be a huge increase in the input cost in form of all this power, raw material, and the employee cost and manpower cost. And at the same time, I'm going to show you, by all these charts in last 1 year, how this major cost has gone up. And the final product prices or the services cost is not going to increase because there is demand pressure is there. There is no demand much because, as you know, in last 2 years, because of the COVID disruption, we had seen the huge increase in the input or the raw material or commodity prices. That was a rally. And because of that only the prices of most of the products has gone up. It's not because of the demand it has gone up. And to tackle this huge rise in, also because of the huge liquidity, there was an easy flow, easy money, because all the way the central banks all over the world, whether it is US Fed or whether it is ECB or whether it is even RBI, they were holding that loose monetary policy, and because of that also that easy availability of liquidity, huge liquidity money was flowing into these commodities, and that was also boosting the prices. But there is a limit to this boost of the prices, because at the end of the day, if there is demand is not going up and there is a huge pressure in demand because the people have lost jobs or the inflation has gone up tremendously, and because of that also demand is coming down. There is a limit to the people's purchasing power. So that is where corporates cannot keep on increasing passing on the price rise, cost increase to the consumers, and that is where the margin compression or the margin depletion is going to happen, and that is going to squeeze the corporate earnings, and that is going to even the multiples, the PE multiples and all the multiples discounting to the market given is going to come down. This is a major fact. And let's see, I will just show you in brief by the chart that how this, suppose this Brent crude, because India is a major importer of this oil and gas. So Brent crude in last 1 year, in last February it was at $61. It has already reached $93. So it's more than 50% rise. Okay, the same way with the natural gas. If you look at the LPG or whatever, the LNG, so this is also, show you. Okay, so if you see this, what was the price? It was $2.9 per MMBTU. And what is the price now? It is $5.50. So more than 50%. Now look at the Brent crude in 1 year. What has been the price movement? Look at, it was $54. It was $61 in February 2021. And look at the price now. It's $93, 54% around. Now look at the coal, because India is a major coal resources country, right? So all the power stations and more than 60% of the power is generated by the coal-based, thermal-based power. Look at the coal prices also. In February, it was $84.67 per ton. This is around $85 last February, 2021. Look at the price here. $230, 165%, more than 160%, almost more than doubled, tripled kind of it. It's tripled the prices from $84 to $230. Major cost, because most of this industry has the major power is one of the major input costs, right? Now look at, if somebody is saying that, okay, we have a manufacturing unit in say UK or Europe, so look at this prices there, the gas prices in UK in last 1 year. $54 per MMBT. This is $54 in GBP. Okay. It has gone to $195. 250% price increase in 1 year. So even if a manufacturing base is in UK or Europe, they are, the huge increase in cost, input cost. Now I will show you this. Okay, look at the cost of some of this but at the same time, if you look at the measure of this suppose for the steel industry, that it is only 13% rise. It's nothing. They are not able to pass on it. The prices have actually depressed. Even last year the prices was this is in the Chinese yuan, steel rebar prices, Chinese yuan per ton, 4,263 international CIF price. And what is this? 4,800, only around 10%. So the prices have not increased in the commensurate portion. So look at the copper. Okay, the copper prices are 20% around, $3.7 per pound. It was last year. It is $4.4 per pound. So it's only about 30%, 20% price increase. So even that for metal industry, the price rise has not been in proportion to that whatever the input cost price. And for the automobile and for all the industries which use metals like copper, steel and different metals for that, so there has been an increase, but not the commensurate increase in this output prices. Now look at some of this wheat prices or this palm oil prices, because one of the major cost is for the FMCG sector in the food is the palm oil price. Look at the palm oil price. It was 3,000. This is in the real, this Malaysian real, the prices are the chart. 3,500 last year per ton real. It is 60% of 5,700. So almost 60% price is up. The same way the wheat prices are up by 17% to 700. Look at the soybean prices. Look at the milk price. Okay, one of the major is milk. These are the international I am telling you, but commensurate, this is USD price, but in India also, commensurately the prices have gone up from $15 to almost like $20, 30% price. Look at the cotton price for all this, this textile industry. Major input cost is the cotton. Look at the cotton price, $86 per pounds. This is a Chicago, trading price, but international, this is the index price. 86 to $125 now in 1 year. How much? 50% up. Look at the coffee price is 90% up. Coffee prices 90% up. Okay. Then so look at the aluminum prices. It's 50% up. Tin is 85% up. Look at the aluminum prices. 50% up. So, in short, just I wanted to share that you are not going to see a very good happy earnings growth picture. Whatever the expectation is there, it will be much lower than this the expectations of the market, and that is why I don't see in hurry there is that market will remain like this way, and I don't see that there is a hurry to rush into the market to buy something. That's it from my side. And if you please like this video, you please put a like and share it with the maximum friends. And till the time next week, we will come out with some new, interesting, unique idea. Till that time, love from Neeraj from Moscow, and ciao to all. That's it.